Hey guys, my name is Robert Zimmerman. Welcome to part four of the Enverus Minerals webinar of 2020. Today we're going to be taking a look at effectively ensuring due diligence in a tight market. So just some kind of quick housekeeping tools before we get into this. You guys are going to, and forgive me, I'm clicking the wrong button there. You guys are going to enter into listen only mode at the present. You'll be muted. Just some quick tips. If you can't hear me talking, if you see my mouth moving, you're going to choose mic and speakers, and you're going to make sure that you're able to hear me coming through that. Secondarily, as we get into the Q&A session, or maybe as questions pop up as we move forward, you guys will have the option to ask me questions, which myself or one of the moderators, if they step in, might help me answer on that. But with that being said, let's go ahead and get started. Just to kind of make an introduction to anybody in here on the call, my name is Robert Zimmerman. I'm a technical advisor here at Enverus. So what that means is we typically have pretty significant industry experience, and we're here to bridge the gap between products and customers. Now, I'm going to be presenting today. Some of you might have watched presentations from Phil or Jay, but I've included them in their contact information as well as mine. Just if you guys have questions, you want feedback, maybe some advice, I just want to make it readily available for you to reach out to us and get that contact information, ask questions as you need and see fit. To give you guys a little bit more of a background and how I found my way into this position, prior to joining the Enverus team, I was the asset manager for Tower Rock Oil and Gas. So that's a mineral rights and royalties acquisition firm here in Austin. And my responsibility was kind of front to back asset management, right? From confirming title, all of the division orders, all of the asset management. And in my time there, that grew to be roughly, interest in 5,000 wells spanning 11 states and 4 different entities. So I got a pretty big handle on, kind of front to back the mineral process. And I used a lot of the tools and a lot of the insights that we're going to look at today to help find success in that. So as we get started, I want to go over a quick agenda just as far as what we'll be talking about. And the first thing is just going to be pretty straightforward, state of the market. I guess that a lot of other presentations that have some sort of similar insight. I want to give you guys kind of my thoughts and opinions. And then we're going to start to get into some kind of basic due diligence best practices. And you can see knowing your area, confirming payment, confirming title, getting in pay, which is, I think, my favorite one. And then lastly, effective asset management, which is something I think I'm very familiar with. And finally, we'll open the floor to some questions. So let's get started and talk about the state of the market. It's very much a weird time for the mineral space right now because we're seeing a lot of our revenue generating, properties, a lot of our revenue generating activities kind of recede. So what we're looking at here is just a basic well starts through time and active rigs through time. And we can see a pretty steep decline starting in March where there's not a lot of activity going on. A lot of those new wells, right? Those, the not just the commodity prices, but the fact that we're not getting really any sort of PUD value out of some of these properties, it has been very impactful for a lot of people, not just the operated side, but the mineral side as well. In addition, for anybody in the acquisition space, it's become much more difficult to evaluate the PUD value of a certain property because in the past, what we might have looked at say, 3-month, 6-month, 12-month forecasted timeline towards when development's going to happen. With unsteady market conditions, and I think malaise is a great word for that, we're not really sure what's going to happen. And so we've seen a big shift towards very much PDP-focused deals, a lot more valuation being put into PDP. And it's been a pretty significant change in the market. Now, one of the things that I think about is tied up capital, where let's say that, January of 2020, you've made a big acquisition and all of a sudden you're tied up in an area that's no longer profitable. And that really kind of changes a lot of things. And I've seen groups shifting portfolios around, moving towards PDP with plans to enter kind of the upside space again. But one thing that I think is really interesting and hopefully an insight I can share with you guys is the fact that there are, in my mind, some benefits towards that. And so I've titled this Finding Value in Disarray. And I've shifted that active rigs through time to as a total percentage broken out by basin. So on the last screen, we were seeing, let's say that significant rig drop. But if we look at it as a percentage of the total rigs, it yields some interesting insights. And in particular, for anybody in the acquisition space or who's a little bit more of what we call an active buyer, the two things I really want to call out are the shift in the rigs, the total rigs percent, towards gassier plays, where in both the Haynesville and in Appalachia, we've seen a transition from less to 5% of the total rigs up to 10% of the total rigs. And, I can go into that a bit more. I've got some other presentations on that. But to speak to that, in my opinion, part of that is to capitalize on the natural gas pricing that is a little more cyclical with the season. So the wells that are being drilled and completed now will likely come online to capitalize on the revenue from that. But additionally, one of the things that I've noticed in my own insights, and I apologize for not having a visualization here, but the year-on-year improvements in kind of cumulative production and EURs and just, any sort of production metric has been fairly significant in both Haynesville and Appalachia, where, in the past, the Permian has kind of been the core focus. Permian and Eagle Ford have been the core focus of some of these improved completion techniques, just because that's where the revenue's been. Now, as time's progressed, right, we see a terrible drop in the oil prices and people are looking at natural gas again. They've been starting to bring in some of those more modern completion techniques, and we've seen very marginal, significant marginal increases in the year-on-year in production, and that spans multiple formations. So, my end goal with this is to primarily identify that there is still opportunities for growth, and there is still opportunities to get ahead of the bit in, some of these other basins. Now, it has become more difficult to evaluate something. That's kind of inherent, but I think it makes the PDP portion of a deal much easier to evaluate, where in the past, in the Permian, you're looking at 360 months is what you're paying on the vertical production with the put-up side. But we're seeing kind of a shift back towards more PDP-heavy pricing. A lot of people are pushing for unitized acreage, SACROC units, the Sprayberry drivers. We're seeing a lot of pushes towards that because it's well leveraged to capitalize on the current conditions. Now, the most interesting part to me, which I come from an economics background, is the fact that it's very much entered a buyer's market. Now, again, if any of you guys saw my presentation at NAPE yesterday, we went into that a bit more detail. But essentially what's happening is, these mineral owners in the past who have been, possibly over leveraged, and they've been balancing that with their royalty income. We're now seeing a drop 20, 30, 40%, not only in terms of production declines, but also the commodity prices shift. And it's a big hit. And piling on top of all of that, with the current market, a lot of unemployment, capital being tight, it's very much, the way I would describe it is a lot of the longtime holdouts maybe are now looking to sell and try and de-risk some of that. And then you're also having, a much larger portion of the market who in the past may have been comfortable is now very much a distressed seller, where I was getting $10,000 a month to help pay off my car. And that has dropped down to, $3,000 a month. And, I need to capitalize on that now. I need to get through where I'm at now. And it has been very impactful. Now, part of that, it's also caused more people to enter the market, which is going to drive up competition, which is going to keep those prices a little more level. But I would say that the sooner you can go in and capitalize on that, it should yield fairly fruitful results. So that's kind of my thoughts and opinions. I won't speak towards the long term. I am kind of feeling, at least in the short term, favorable towards natural gas, just because, like I said, it's a good time to capitalize on those cyclical pricing environments. But I won't presume to speak towards the oil market, just because I think that there's so many factors in play, and it's tough to say where that's going to go. But let's go ahead and just kind of talk to some of the due diligence best practices, right? I've been involved in a few hundred deals. I've seen the good ones. I've seen the bad ones. And I just kind of want to call out and ask you guys some rhetorical questions towards what makes a deal easy for you, right? And I like this quote: "Diligence is the mother of good luck," from Benjamin Franklin, which in my mind is, if you're doing your diligence, if you are kind of staying ahead of the game, then, you're going to find good luck. And so something I think back on is, right, willing sellers, that they have everything ready. They know what they own. A real plus if they've got siblings or family members that also might be looking to sell. Quick, easy title, I think, to Appalachia, right? West Virginia, Ohio, when the estate's only recently been severed. Again, that's pretty easy. We bought some stuff with life estates. That's why I put that in there. And that was an absolute nightmare to figure out how to track. But quick, easy closings, right? This is the ideal situation. But, as anybody on the call can kind of speak to, it's not very often that all of these kind of line up. And so on the other end of that is, what might look good, but quickly falls apart. My favorite one is, okay, I've just been getting checks. I don't know what I own. I don't have leases. I don't have division orders. It's just been mailbox money. And all of a sudden, it's a lot more work to try and figure out, okay, are they actually in pay? Should they be in pay? Are they in pay at the right decimal? And then there's always the people that are trying to haggle you on the deal where, they're telling you, well, this person's offering me this much and this person's offering me this much. It's just frustrating to deal with. And two, I'll tell you, we've gotten burned in terms of complicated title. We've been a bit too hasty on title, and we overlooked the conveyance from 2012. And we ended up paying somebody for something that they didn't own. All these can kind of compound together. I've got ghosting as a good example. There's been plenty of people we've talked to, we've never heard from again. We've got the trick where I still haven't received the payment. Can you send another one? And then lastly, again, my favorite and kind of my most frustrating point is getting in pay, right? Dealing with the owner relations department, handling any sort of discrepancies. That's in my mind one of the most nightmarish places. And then again, I think this quote's fairly relevant, where if at first you don't succeed, destroy all evidence that you tried. So we're going to get into what, in my opinion, is kind of the first and primary thing in any sort of due diligence, right? And that's just knowing your area, know why you're buying what you're buying. And so I just took some stuff from one of our tools just to give some insights in how I start to approach an area and how I look at an area and evaluate a deal. I'll tell you guys candidly, I'm very much an operator first approach in terms of mineral acquisitions and evaluations. In my mind, what you're looking for isn't always necessarily top tier production or top tier rock. But I like to factor in the consideration that, let's say Cimarex in Reeves County might be sitting on some great rock with some great results, but their drilling schedules are much less so than, say, Oxy, than Centennial, than Concho. Some of these other groups that have a bit more capital that can more aggressively drill up their acreage. So I actually took this from today. And what we're taking a look at is just kind of quick high-level overview, right? Who's running rigs at the present? It's pretty straightforward, right? Concho, Crown Quest, Diamondback, Exxon, Pioneer, SM. And then who has been permitting well. So this is something we actually recently added, and I'm a pretty big fan of it. But what we're looking at is kind of a time-scale delineation of not just the number of permits, but when that permitting activity has happened. So, already Q3 2020, we can see that Pioneer has been pretty consistent throughout this, right? They've got some great acreage. They've got a ton of places to drill. And that's really no surprise here. Now, what's interesting is they are very much in that kind of tied for third in the number of rigs that are running. So what that tells me, and something that I found, is historically Pioneer typically waits a while to drill their wells after they permitted them, versus someone like Exxon who, I've seen they permit a well and they're drilling it within the next week. And again, just to kind of gather some insights, let's say that you have, you get a call on a deal, or you have some sort of interest in a Crown Quest operated position. And pretty quickly I can see that Crown Quest has 3 rigs running in the area. So that's a good indicator. But if I drop back down to this, I see that they've been permitting a lot less than, say, Concho, Diamondback, Pioneer, again, right? And so that makes me a little bit more cautious in terms of picking up some of that acreage. just because I wouldn't know the right way to approach a discount if they don't start to go in there and develop that. Versus Concho, which is, very straightforward, right? They've got a lot of permits recently. They've got a lot of rigs recently. And it's just kind of knowing the operator that you're buying under. And I'll get into an example where we got burned on a deal. But the next thing is that I look at is operator performance. So again, we're looking at the same exact map that we looked at in the last screen, but here we can actually see the operator performance kind of broken out and tiered out. So like I said, performance is great, geology is great, but what I really care about is, when that's going to get drilled. So while Crown Quest has several rigs running, while they've got several permits, and sorry if anybody in here is on the Crown Rock team, but I can see in here that they're kind of middling tier versus the Concho, which is actually slightly below them, or the Diamondback that's slightly above them. And so I think it's important to, kind of appropriately scale your, the price that you can pay up and down according to who you're talking to. And especially in a growth-oriented market like we are, a growth-oriented industry, I think that very often we get caught up in just trying to close deals. And I think that you can very quickly make a mistake by saying that you're going to pay as much for hunt acreage or Encana acreage as you would for SM acreage. And I think that that's something that's very important to consider. Along with that, I've also got kind of a time scaled, right, by first production date, the EURs. And what I typically look for just in that graph is who has made measured improvements over time. So Pioneer, right, we kind of see them in the upper tier. We see Crown Quest kind of middling where they're not really reaching those upper echelons. And we see Endeavor kind of spike up and kind of come in on the upper end. So again, that's something I think is important to consider is we can't take all of the data as a single time point. We have to factor out how those changes have happened over time. So the next thing that I've got and that I think is important to consider is the geology of the area. So I like to go to Martin County, for example, just because it's got a lot of activity. It's also got a lot of undeveloped acreage. So what we're looking at here, again, is going to be that same map. But here we've actually broken out those production profiles. And again, this is cumulative oil by the formation. So this is actually going to be not proprietary. It's going to be accessible to customers. But this is something that we go in and we interpret the data. We've got a pretty robust stratigraphic model for all the major unconventional basins. We take those horizontal surveys and we'll drop them in those models. And from that, we're able to identify, what formation that's producing from. And I'll say confidently that we do that with very high accuracy. Now, one of the reasons that I particularly like Martin is just the abundance of productive formations here, where, again, if we look on the map, we can see where we've seen stellar Wolfcamp C wells, stellar Wolfcamp A wells. And what I've really been keeping an eye on, kind of in accordance with recent press releases, is the Dean, which historically hasn't been an incredibly productive formation. But if I look into the kind of scale and the comparison, I can see that the Dean is up there with the lower Sprayberry Shale and just below the Wolfcamp A. And so I think that that's important to know and to keep an eye on, what formations are going to be productive under my acreage, right? I can't say confidently that, if they drill a Barnett well in here, it's going to be very fruitful. But if I'm starting to look at a deal, to approach a deal, or even just evaluate my current acreage, being able to add that additional formation in there helps, one, in terms of, valuation, being able to bring value to investors, to customers, to clients. But secondarily, it gives you the opportunity to kind of be more aggressive with some of your valuations, where I can see that the Dean's productive. I can see that they've only drilled the Wolfcamp A. I know there's still Sprayberry Lower Shale. And I think it's very important to just kind of have some sort of idea of what's productive around you. Where has it been fruitful? And I mean, we could even take this a step further and break that down by operator. But again, we've stayed pretty high level on all this. And the last thing that I want to touch on in terms of knowing your area is just knowing what the operators are doing, right? Where right now, Pioneer, Crown Quest, Concho are running a ton of rigs, but they might have different plans for Q4, different plans for the rest of Q3. And so I took this from what we call Intel Bytes, and I just looked in and looked at drilling schedules for Permian operators, and Diamondback's always a good example. They do a good job of putting their information out. But going in with the knowledge and making acquisitions or even asset management with the approach and understanding that, okay, during the rest of the year, I can expect Diamondback to at least drill 205 to 215 wells. We'll just call it 200 plus for simplicity. And that gives me some powerful insights, because I can then take what we saw on the map and start to diligently find those areas where Diamondback has had good production, where they've got room for 2-mile lateral development. And again, I don't want to tell you guys you can confidently get ahead of the bid on this, but I have done some of my own work and been very successful in an approach similar to this. So it is important. Again, this is a good example where they are continuing to drill wells. I could have just as easily pulled up an example where they are backing off on their aggressive drilling plans just to wait for the market to recover and to kind of recuperate some of that capital. And again, I mean, that's kind of one of my thoughts is when you're making an acquisition or even when you're evaluating your own property, it's important to consider when that's going to be drilled and kind of what the expectations are from the operator. Right. We can see their production, we can see their permits, we can see how they're doing geologically, but we don't have any sort of insight into what they're going to do in the future. And I think that this is incredibly important because, like I said, you could be under a great operator and a great rock, but if they're constrained with capital, they might not be drilling that till late next year. And I mean, that's tied up capital. You could be pushing that in the Haynesville or Appalachia or buying PDP deals with that. And again, I think that we very often in our industry find ourselves just kind of aggressively chasing deals without taking into consideration what it's actually worth and what that upside looks like and trying to quantify it. Now, to speak to my direct example of a deal gone wrong where something like this happened, is we were looking at a deal under Abraxas in Ward County. And I apologize. I like to bash Abraxas a little bit just because I know where Felix and Jagged Peak have done better. But our engineer went in there and he looked at the results that Felix was having, looked at the results that Jagged Peak was having. And we paid, a price that was more similar to what we would pay for Felix or Jagged Peak acreage than we were for Abraxas. And I get it. It's got current PDP, somebody might be willing to pay that much, but it sat for 2 years and it's still undeveloped. We still don't have any wells on that acreage, and that's sunk cost. I mean, I don't even think that we'd be able to get what we bought it for if we wanted to turn around and try and flip that. So, I think this is straightforward. I'd say most people in the mineral space are very diligent towards this. But just kind of using tools like this, leveraging technology, starting to look at some of those quarterly reports and earnings calls, and seeing what those plans are gives you a better idea of, one, how to make diligent acquisitions, and two, how to kind of grade your own current portfolio. Now, the next thing, and I'm not going to presume that everybody's processes are the same, but one of our big steps in acquisitions was confirming that they were actually in pay, and they were in pay for what they said they were, and that, the decimals were correct and aligned with what we thought they were. So most lead generation for anybody in the acquisition space is going to be from the tax appraisals. It is going to be from respondents list or maybe even lease information. Now, that's good, but the issue with that is that's very much a timestamp data point where, at this point, the 2020 mineral appraisals are going to be released here pretty soon. And if I'm relying on those 2019 appraisals, then, very often we ran into issues where it had already been conveyed out. Now, if somebody is let's say a bad actor in that party, or they're being negligent, they might have already divested of that. And, if you're not doing your due diligence to see, okay, when are they in pay, or if they only have pay stubs up to January of 2020, those are all red flags to be conscious of. And I think that, again, we kind of fall into this bad habit where, okay, they're on the phone, it's going to be a deal, we're going to move forward on this. Or, they're interested, they want to sell, it sounds really cheap, we want to move forward with it. And so our best practice was dig up absolutely everything you can, right? We want checks, leases, division orders, Have you gotten any letters? Have you gotten any statements? Pooling agreements, anything that you have to help us verify ownership, absolutely essential, and kind of, one, not wasting your time, but two, making sure that you don't get burned. So you guys will see this pretty often, but I brought in, leveraging technology to assist with this, because it is something that I've personally found a lot of success with. And two, it's a tool that's pretty readily available to a lot of people. But the Texas Mineral Appraisals is something that we have that most shops use for lead generation, right? They can take it out, they can send mailers super easy, they can look up certain decks, but it also gives you some valuable insight if you're looking year on year as far as how those ownership changes might have happened. So my example of when we used this to go in and validate was that we were contacted by two sisters whose father had recently passed away, and they weren't in pay yet, and they didn't know what decimals they were going to be in pay on. So what we were able to do was we were to go look at the mineral appraisals year on year and see where his name was listed, and look at his will, and kind of see how that was conveyed out. And even though we weren't in pay, because they had the documents, because we had these tools, we were able to go in there and just do some quick math and say, okay, this sister is going to be at this decimal, this sister is going to be at this decimal. She's got all the statements, we can kind of do our own math on that. So I think that this is, a fairly straightforward assessment. But for anybody on the call, anytime that you can get information, it makes it so much easier. It helps with title, and it also helps with an exit if you're flipping deals, if you're looking to exit a fund. Having some sort of supportive title from prior to your own acquisition is always a green light, and really helps close deals. Now, the next thing we're going to look at is just kind of confirming ownership and title. And I'm not going to give you guys some sort of brief on current case law or any sort of precedents that have been set, but just kind of give you guys my thoughts and opinions towards being diligent in title. So I've just got a picture of a basic run sheet. In my experience, I've talked with a lot of groups, and some of them are very adamant about running title on absolutely every deal. And some of them don't run title below a certain threshold, where maybe it's only a $10,000 deal, $50,000 deal, or, it's only bringing in $50 a month. And I get that, I see some of the benefits to that. But my thought is, okay, what if that $10,000, deal, or that $100 or $100 a month well suddenly sees unconventional development, and you aren't in pay on any of the 4 wells that are absolutely gushers under it? Then you're lost, and you have to go back and confirm, okay, is this actually, should they actually be in pay on this? Why aren't they in pay on this? So I'm very much adamant about you should run title on every deal. I realize that's not always the most cost conscious, but I am fairly risk averse. And I think that, the one deal where it's going to have been important to run title is going to pay for all those other deals and pay dividends on them as well. So like I said, we've run into some title failure issues. It's time consuming to fix. There's a lot of back and forth. I think we had to attorney up at some point. But it can blow up in your face really quick. And, even if if you are diligently running title, on, let's say, a $500,000 deal, $1 million deal, I say double check, triple check other records. You want to be able to get it and see, I think it's pretty straightforward here that you don't want to make any mistakes on that. The other thing too, that I think is important, especially with, tightened capital in the market that we're in right now, is finding ways to keep costs low. Right. And I bring this up, and you'll see in another slide. Chilling and billing is a term that I've heard used to describe contract landmen, where, you're getting billed for a week's worth of work, which really only has been 10 hours worth of work. And it's very difficult to control those costs, especially if you're trying to get something done on, I need this done in 2 days. And they're saying it's going to take a week, but really they could have knocked it out then and there. They just want to drive the bills up. So something that we have and we've put together to kind of help support title is we have our own online courthouse. And I will speak candidly, and it's going to sound biased here just because I currently work for the company, but I have used the Texas files, the Courthouse Directs, county records. Candidly, I will say I think that Courthouse is primarily the best interface. I'd say there's probably a lot of overlap in coverage, but I think back to times where I was having to click through several different pages to search, pay for the document, download it, print it, versus, Courthouse, where we have these abstracted title plants, which is what we're seeing on the map. But if you haven't looked at it, it's worth it to check it out. I know that sounds salesy, but it really has saved me a lot of time, even prior to coming over to the team. But that's one of the big things that we try and pitch is, going to the courthouse. I don't want to say it's outdated because there's a lot of people that still do that. But in my mind, spending time with your family, being able to do it at home in your PJs, that's always a lot easier. And I've talked to people in Austin who are driving out to Pecos every other week to go to the courthouse, and it blows my mind just because there are options online, to quickly do title search, pull up every document in this section every time this name is mentioned. And so part of that, what we're looking at here is because we've gone in and abstracted these out, and we've captured the location descriptions, you're also able to drop that on a map. So if there's any sort of Scrivener's errors in the land description, if there is something misfiled in the wrong county or improperly identified, it's a really good bucket to try and catch some of those. So this is just a quick example. I've pulled mineral deals in the past 6 months. Those little courthouse icons show where they're at, and then the colors show, who was the grantee in that. But, this can be done for easements and right-of-ways. It can be done for probates. It can be done with plats. Really any sort of document that you're going to need and maybe you're having trouble finding, this is an absolutely stellar way to go in and do that. Now, additionally, one other thing that might be coming to mind for some of you guys is it's also a great option for market research, where I want to see who's buying in an area, who beat me out on a deal, right? Where are the big aggregators interested? Where have they been active? And that also does a very good job of exemplifying that. Is I can see where Echo's been buying. I can see where Swallowtail's been biting, where Viper's been buying. And so in addition to being able to run that title, it also is a pretty powerful tool for market research. And just, again, I think it's incredibly important to know what's happening in and around your area. Now, again, my firsthand story, which, I couldn't remember the specific count. It was Hemp Hill, Texas. Hemp Hill, we were having trouble getting in pay on a few wells. And after digging around, we finally figured out that the probate had been filed in Wheeler County, and that UDEN didn't have access to that. So, we were able to just go in and pull that up and, pretty quickly find those names and send it over and get and pay for a pretty significant chunk of money. But like I said, having that by a map, being able to search, across several counties instead of just one county at a time has been incredibly beneficial to me. And we've gotten a lot of praise from a lot of our customers towards that. Now, the last thing that I want to show you guys is kind of towards our chilling and billing. And just to give you guys some background, kind of how this courthouse tool came together, and a lot of our land products actually come from, is our GM of land, Silas Martin, formerly was a broker. And so, he knew how it worked. He knew how to improve it. And when he came over, one, he made the interfaces that we're looking at. But two, one of the issues that he really had was the chilling and billing that's happening in the industry, where, like I said, there's no real way to know and confirm what it is you're actually paying for and if the work's being done. So in addition to the courthouse and the ability to run title, we also have what we're looking at where, one, you can grant contractors access to courthouse, which is, incredibly easy if you're working in an area you're not familiar with. Maybe your plate's full. Maybe you do everything through contractors. You can grant them, you can pay for it, and you can give them access, turn it on and off as they need it. And you can share these run sheets with them. But the real power of that is the ability to track metrics. And I've heard this described as a bit Big Brother-esque, but I pulled Rachel Toddco, who's an employee here, and I want to go in and see how long was she using this tool, how many times has she logged in, how many documents has she printed, so that when she comes to me with a bill, and I'm expected to fork over $4,000 or $5,000 or whatever that fee is, then I can come in here and I can say, for what? You haven't used any of this. I made it quicker and easier. And it's very much a great tool in terms of, keeping an eye on that. Again, especially now when let's say budgets are a little bit tighter, managing those costs, working with contractors, it just makes it a lot easier in my mind. And again, I'm sorry if anybody was hoping for some interesting case law and precedents. I'm not quite an attorney, and I'd be remiss to try and speak towards that. But it's really just about kind of using the tools that are available and just being conscious of, how can I do this better? I think that the oil and gas industry has historically been very technology averse. And, if you could do this at home, if you could run title at home and not have to drive out to San Augustine County, drive up to Hemp Hill, drive out to Pecos, how much time and money would that save you? And it's pretty instrumental in just being able to kind of leverage those tools. Now, the next part, and kind of my favorite part that I put together here, we'll call getting in pay. So that was always my biggest frustration, and I think that this image does a good job. This is Ross from Monsters, Inc. But I will tell you guys, I had so much trouble getting through to owner relations departments, getting in pay at the proper amount. Consistently we found that they were conveying to the wrong entities. We had several different entities. They were conveying to the wrong entities, the wrong amounts. And in my mind, what should be fairly straightforward always had some sort of added difficulty to it, whether you can't get a hold of anybody, or they can't get the documents right, or they can't get the curative right. It's pretty important. So in the past few slides, you guys saw some kind of bolded out important tips and tricks. I was going to bold all of these out, but it just didn't look very well. So consider all of these, fairly important tips and tricks here. But my argument has always been make it as easy as possible for them to do their jobs. And again, I'm not trying to downplay anybody who's been in the owner relations department. It's just been my personal experience that I've been very frustrated in trying to get some of these transfers going and trying to get pay on a lot of these wells. So first big tip is clearly state the entities, clearly state the owner numbers, right? All they have to do is they don't have to, mistype anything. They have to type in that owner number, which is a field. It's pretty quick and easy to pull up. And again, make it pretty clear who is conveying to who. At Tower Rock, we had another entity that we always conveyed 12.5% to, so an eighth. And we always clearly stated 100% here, this to this. And again, just make it as clear and transparent as possible. The next thing in terms of their ownership is to try and state the land. So if there's depth severance, if it's only a well bore, if it's a certain quarter call, always try and get that in there just so they can see it. They can quickly get to it on the map. I'll say a lot of operators use our tool, and a lot of owner relations teams use our tool to help validate things. But it just makes it that much easier for them to check the box. The other advice that I have towards that is try and state the property IDs. And if anybody's trying to take notes on this, in the next slide, I give an example of a letter that I would have sent to help get in pay. But again, all those property numbers that they're in pay on, all the property numbers that they should be in pay on, make it as absolutely easy as possible for them to go in there and pull that up. So as they're looking through that, they can say, okay, transfer that one, transfer that one, transfer that one. We're good. The last thing is to attach the documents, whether it's just a conveyance or any sort of associated curative, and clearly state in the name, right? Mineral deed, this entity to this entity, this county, this date. And then something that I found a lot of success in, especially in certain groups or operators that I had issues with, is I would go in an Adobe PDF, and that's not a pitch there, but I would highlight the explicit land description. I would highlight the parties. I would highlight the percentages. If there was anything such as the conveyance of funds in suspense, I would always go in there and highlight and make sure to not just highlight that, but call it out in the actual email or letter that I sent. And that has been profoundly helpful for me. This is something that I typed up. I was thinking back to kind of my experience and kind of what this looked like. And I'll read it out just to sounded out so it makes sense. But to whom it may concern, please find attached a recorded copy of the conveyance from John Smith. Again, that owner number is incredibly important to Via Fortuna Minerals, effective this date for the following lands. And so, again, clear, very easy. I pull that up. I pull up John Smith. I go to the other owner, show that transfer. This is the lands. And then in terms of checking those boxes, you can see I've got each of the properties stated, as well as their, I've heard property ID, property number. It can vary company by company, but it just makes it a lot easier. Now, the one thing I will say is that if you are, making acquiring a pretty large portfolio or a significant number of assets, that property identification and those property IDs can balloon up pretty quick. I won't say this is always necessary, but it definitely helps and it makes it a lot easier. The other thing I would say is that a lot of people, their natural processes, their operational processes are to get that notice of the conveyance, and then they send out a division order in the snail mail. And I'm trying to get and pay as soon as possible, right? I want to turn that capital around. So something that we found a lot of success with was letting them know, hey, if you can send it via email and process it via email, I can get it back to you right now, right? I can sign it, I can get it back, and make it way easier. And so if you guys aren't doing that, or if that hasn't crossed your mind, I think I even built a mail merge template at Tower Rock to help process some of this. But it really speeds up a lot of the process. And I found that after we implemented this, we ran into a lot less issues with, missing properties from the division order, improper dates, conveying to the wrong entities. And again, just being clear, concise, and transparent in what needs to happen. I've had a lot of success in. The last part I'll speak to on this, and I didn't really add a bullet or a note towards this. I found that, if you are having trouble getting hold of anybody in owner relations, or any of these groups or these parties, I found that sending an actual letter goes a long way, because for a lot of leases and a lot of operators, written notice is the first kind of step to trying and break the lease. Now, I wasn't in there trying to bust up any leases, but they look at it with a lot more severity than they might the email through the standard owner relations line. So something to keep in mind, again, just in that general diligence, if you can't get a hold of anybody, send a letter. And I got calls as soon as they got that letter. So pretty funny to think about. And so the last part isn't necessarily tailored towards the acquisition side, but it's kind of the side that I was most comfortable with and where I spent the most time, which is the asset management portion. And before I move on and get into the other slides, one of the reasons I want to speak to this and why I think it's so important in terms of diligence is that firsthand, we, in our first fund, our first portfolio, we didn't do a very good job of keeping track of things, right? It was, I think, 2014, late 2014, early 2015, right? Everything's super cheap. And we were just buying stuff up. Now, come 2017, when it's time to start to look to exit the fund, we are quickly faced with a very compromising position because, one, we don't really know what we own. And two, as I started to look at this, we pretty quickly found that we weren't in pay on quite a lot of wells. So, that's 2, 3, 4 years of revenue, especially in a majority of our first portfolio was in the Midland Basin with very significant upsides. It quickly turned around to bite us. And I had to suffer through going in and digging that up. But, part of that is it gives you the opportunity to proactively stay ahead of permits and rigs. But additionally, if you are looking to exit, if you're looking to sell parts of your property, if you're looking to reshuffle your portfolio given market conditions, it makes it much easier to sell if you can say, this is exactly what I own. This is where it's come from. And that's kind of the impact that I felt is, at the time, when it's just in your portfolio, really the primary concern is going to be, making sure you stay in pay and making sure you get in pay on any sort of new wells drilled. But what I found was, the better you have your stuff organized, the better you have it digitized and readily accessible, the much easier it is to sell. And furthermore, if you are working with investors, whether it's a PE company or you're privately backed or institutionally backed, getting that to investors and saying, this is exactly what we did. This is how it's performed. These are the wells that we've been in pay on or started getting pay on. It really opens the line to a lot more transparency and communication, where as you're starting to get into these other funds, as you're looking for lines of credit, other sorts of financial instruments to support you, it just makes it a lot easier to have all of that readily accessible and digestible. So first thing is pretty straightforward, know what you own. I took a shapefile of Blackstone's company acreage from our company acreage. I dropped it in the map, and I drew an area of interest around it. So what that's going to give me is, one, it's going to give me the actual shapes of each of the tracts that I own. And this is at the most basic level in terms of accessing our data. Additionally, this is the only place right now that proprietary data can be hosted. And at Tower Rock, I had all of our shapefiles in, and I could click into each of these properties, and it would tell me, this is who you brought it from, this is how much you own, this is the acquisition price, the effective date. And really just having that on the map and being able to see, okay, how does this tie in with the future acquisition? What activity is going on in the area? Really gives a lot of transparency towards where the value of your portfolio is. Additionally, the nice thing about this, we have something called Virtual Scout, which is how I got that nice little 1 mile buffer there. But with that, what it's going to do is it's going to give you a notice anytime there's a permit, anytime there's a rig, anytime the well status changes. So if it goes from DUC to completed to producing, you're going to get a notice on that. Same thing goes for operator changes. If there's a change of hands, right, with, I'm mixing up my companies here, I won't go into it. But it's very impactful. And I had that running every single day. So I had our portfolio in, and I'd be able to see day of, okay, this is when that permit's, this is when it's brought online. And I can keep track of when the status changes, where I can see, okay, it's now being drilled, it's completed. And I can really get ahead of them and say, and I think back to a good example I had with Encana now, Aventiv, where I could reach out to them before the wells were even, completely producing. And I can say, hey, when can I start to look to expect the division orders for this? I like to think I was kind of cutting in line in terms of priority there. But when you're looking at, not getting in pay or not even getting division orders, I think my worst example was 2 years for Oxy. We couldn't get a hold of them on it. We couldn't get in pay. 2 years for Oxy, and they wouldn't put us in pay, and they wouldn't send us division order. They had all the title lined up. They confirmed it. And I think that, the longer time goes between that well being, well starting to produce and you trying to get in pay, the more difficult it is to get in pay. The odds of error go up, and you're also facing the fact that you're not getting that money when it should be coming in, which is, if you are looking to return money to investors, turn some of that capital with other investment, I mean, it's absolutely monstrous. So, having a good idea of what you own, keeping an eye on it, it in my mind is one of the absolutely biggest and, most impactful, things you can do to help manage a portfolio. So that's what, that kind of looks like here. This is pretty basic. Like I said, you can find wells you're not in pay on. I think when I did our audit, we found like $60,000 a month of wells that we weren't in pay on. So just to kind of help tie that back, there's probably some money sitting out there if you guys aren't doing this yet. Could be an opportunity to go dig up something big. But the second part of this that kind of ties back to the, a few of the things that we've talked about is having a good line of sight towards your revenue and where it's coming from. So I like to think of EOG checks as an example where, as I'm looking at the statements, I see Eagle Ford wells, I see Permian wells, I see Bakken wells, I see some Barnett wells. And, when that's just on the check statement, I don't have any way to tie that back, that revenue, let's say it's $3,000. I don't have that way to tie that revenue back to a certain operator, a certain basin, a certain acquisition. Right. All I can say is I'm getting this much from EOG, this much from ConocoPhillips this month. I would say that works for a lot of people, just because historically, right, it's really tough to process that paper data. But with the advent of some of this more modern technology, it opens the door to being able to track details at the well level, roll that up to the unit level, roll that up to the track level, the acquisition level, because when it comes time to exit, to get funding, to report to investors, in my mind, it doesn't say much to give them, this is how much we brought from EOG. In my mind, it should be in the past 6 months. This is how our acquisitions have performed. We purchased this much interest. We paid this much. And we're able to kind of see and delineate where each of that, all of that revenue is coming from, and really just open the door to a lot of things. And I think that this is kind of the next big step in the mineral space and towards leveraging technology. Just because I won't name any names here, but I know there's some big groups that have a room full of people that hand key check stubs. And that is expensive, time consuming, error prone and outdated. And when you've got, certain tools, right, MineralSoft, OilDeck, EnergyLink that can streamline the import of that data and tie it back to a portfolio, what does that mean for you? Can I say where each property, how much revenue is this property bringing in, whether it is by well, by unit? If I do want to exit just that property, can I continue to track how my acquisition performed? Can I continue to track the revenue on each of these different bases? Maybe I have, 2 separate interests in one well or one unit, and I want to divest of one of those. How do I change the tracking? So, this is the modern, obstacle of the 21st century in my mind in terms of mineral management and acquisitions and due diligence, is just being able to break out your revenue because, like I said, line of credits, investor reporting, securing additional funds, proving your performance and your success can really go a long way. And, maybe that's what it's been is historically. I think that, mineral shops have been kind of like the PE model where they hit the jackpot on one thing. And as capital has become tighter, and there's been a lot more scrutiny towards the performance of these investments, being able to show your success, being able to show where that revenue is coming from. It should be absolutely revolutionizing in terms of being able to come in and track something. With that being said, guys, I'm going to end it, and that's kind of my last point. I'm going to open up the floor to questions, and we've actually got quite a few opportunities for questions, and if you guys let me know, I'll pop back and we can show where you can enter those questions. So let me know, guys. All right, let's see. Awesome, guys. We'll give it another few minutes for questions to roll in. And if we don't get any more, I'll give you guys 5 minutes of your time back, and we can all go on our day and feel a little bit better from learning quite a bit. Well, guys, it looks like we don't have any questions coming in. So we'll go ahead and call the meeting. If you guys have anything, oh, there we go. Thank you. That's a question right there. So what trends are you seeing in terms of operators purchasing offset minerals? That's a stellar question. So I presented at ERTEC, I guess back in July of favorable economics, and it was primarily towards royalty relief. But in terms of mineral acquisitions, and this was a very specific case. I've tested it across basins, but it was looking at Exxon wells in San Augustine where Blackstone was offering them royalty relief. But what was happening was with every kind of 1% improvement in net revenue interest for the operator was worth an NPV of, I think, $290,000 per well. So, in my mind, you can pretty quickly tie that back to a per acre value. And I think that a lot of operators would very much benefit from the kind of Viper model. I know that Continental has been kind of tight-lipped, but I know that they've been buying minerals. I know that Exxon has some mineral holding companies. Chevron's got a ton. I haven't seen much aggressive acquisitions. You know, the economics are very much supportive of it, but I think that it could be a bit taboo in terms of, you know, what I was told by a head of land at a pretty big E&P was it makes sense, but it also kind of compromises our position as a good actor in this market space where, you know, right, the operators essentially have all the agency to determine the value of the minerals. Now, if the operator also has the minerals, they can, you know, impactfully determine the value of the minerals because they can say, okay, we're going to drill here. But they can also start to hold people hostage where they can say, if you don't sell half your interest, we're never going to drill here. And I don't know, that is a stellar question. If you want to email me afterwards, I'll send you over my presentation and you can look at the math on that. But I haven't seen it. I wouldn't be surprised if it's happening. I know Continental has an entity name that is in no way related to them, and they're very secretive about it. You guys didn't hear that from me. But I think that we might see more of it kind of as time improves, because I also did it with Diamondback and Pecos, and I think that it brought the break even down from like $43 or $44 down to like $36. And so it's just kind of balancing the cost of, can I acquire the minerals in a way that, you know, at a price that significantly impacts my economics. And then there's also the fact that, you know, you can drill more wells. You know, developing the acreage in its entirety makes a lot more sense if you're only having to pay out, you know, let's say 12% of the total revenue, or even less if you can get a smaller burden there. But that's a absolutely stellar question. Any other questions? I'll give you guys a second here and drink some more water. See if I can see who's typing. Gotcha. Well, guys, with that, I'm going to go ahead and end it. Like I said, if you guys have any additional questions, maybe there's something you're not comfortable posing in front of the other attendees, please reach out and let me know, and I'm happy to, you know, talk through some of this a bit more. But thank you guys for joining this in the Enverus Mineral Series, and I appreciate you guys taking the time to sit in with me and hopefully learn a bit. So thank you guys very much.